COVID-19 caused a recession, so why did the housing market boom? Crash coming? The fate of the housing market could hinge on regulators' success in preventing a wave of foreclosures. Searches for the phrase, is the housing market going to crash, are up over 2,500% in the last month alone. The housing market is hot, but is it too hot? Those are the questions we're going to cover on today's agenda. I want to talk about the update on the state of the housing market, transition to forbearance, rental moratorium. There's some updates there. And what's the future hold? Is there going to be a crash? To figure some of this out, we have to look back to move forward. And if we look back to March 16, 2020, the Fed cut rates to zero and launched massive $700 billion quantitative easing program, purchasing treasury and mortgage-backed securities. And banks did tighten up last March, requiring a 700 FICO score and 20% down. More conservative this time around compared to the subprime mess when we had those interest-only loans, those balloon payments that were due at the end of 3 to 5 years, all those teaser rates. So it's good to see that the banks are more conservative this time around. When we talk about cash out options, I did a video on this. I'm seeing up to 40% of people who have done refinances over the last year have pulled cash out, low end 30. But I've seen some internal data and talked to bankers, it's higher. So let's just say 40%. And I did a video on this. Yes, if you're pulling that cash out, using it for investments, to buy a rental property, to put it into the stock market, and you're not using it to go on a spending spree, or a nice vacation or what have you, or buy a car, which would be dumb. So what are they using these cash outs for? A lot more people right now have equity in their homes compared to the last subprime mess, which is good. But those people that only have 5% equity, and we did a video on this, and interest rates go up, you're going to be underwater. So I'm seeing a lot more people have equity in higher end markets and lower end markets than they did compared to the last crash. So that is comforting. And banks are being more conservative overall this time around. But, some banks with the cash out said, oh, you got to have $250,000 in the bank. Some big banks, I called over 40 lenders. A lot of them didn't have any requirements like that and allowing people to do cash out. So you are seeing people are going more into debt. They're going more into house debt, pulling cash out, extending their mortgages, taking SBA loans. Americans are going more into debt. So I don't think that's a good thing. Some of these PP loans, partial, are forgiven. There are some forgivable portions of it, but when you're taking massive amounts of loans from Small Business Association, you're refinancing your house to longer loan terms, you're just renting your house from the bank and you're getting more and more into debt. So that's concerning to me. After robust gains over the past 5 years, the nationwide nominal house price index is now 40% above its 2012 low point and 4% above the peak reached in 2006. So if 2006 was a historic bubble, then current price levels should be looked at more closely according to JP Morgan research. So there are some triggers there. Bottom line, slowing employment recovery and still high unemployment levels are not supportive of long-term sustainable price house growth. So we look over the course of the COVID-19 pandemic, 70 million people lost their jobs. I did a talk on this. A lot of those people that lost their jobs made less than $37,000 a year. Take the state of California, 1 in 12 jobs is in the hospitality sector. A lot of those people are renters, not owners. Making over $60,000 a year, those people overall did not lose their jobs and they're homeowners. So that's why people said, well, there's massive unemployment. Well, what's going on with the housing market? You have to break it down and look at it from that perspective. But there are some concerns there with long-term price growth and, a lot of contraction in the commercial real estate market, people curtailing their office space, realizing they can save money, people working remotely, furloughs, jobs cuts, restructuring in companies. That's all still going on right now. So given that the last housing boom triggered a global economic meltdown, these concerns are certainly understandable. Another economist estimates that national home prices are approximately 5.5 to 6% overvalued right now. Economists overall are saying there's not going to be a crash, just like we were told in 2006, but a cooling off. So if you remember a lot of the internal data, some of the stuff we were ahead on back in the day, but they were hiding data and the subprime and what was really going on, what these banks were doing. So really do your research and dig into it, and if you know bankers and these things, and find out what's really going on. So yes, there is some comfort and some concern with the regulators and what they're going to do, just like we're pumping money into the market right now with all the quantitative easing and printing of money. Some of that gives me heartburn. So they think there might be a cooling off period. So when we look at what COVID hit, home buying market came to a screeching halt. We were all told to stay home. And then when real estate transactions were allowed to continue and we figure out what we had to do with Zoom and meetings and policy and procedures from the National Association of Realtors, home buying resumed. Americans flocked to buy homes because of the ultra low interest rates, ultra low inventory, and also, we have ultra low construction. Over the last 10 years, there's a labor shortage. So with jobs turning remote, people learning from home, children going to school at home, families sought more space. So families sought more space for their primary residence. And also people said, hey, this pandemic's driving me nuts. We want to get a second vacation home. So you did see an uptick there, which was interesting. So here's a couple of pearls. The U.S. house prices in a quarter of the county's metro areas are more than 10% overvalued. U.S. home prices in a quarter of the county's metro areas are 10% overvalued. And in 2020, we saw a 12% gain in construction of single-family homes that, as you know, caused an increase in lumber prices. So as I said, over the last 10 years, they're still behind home builders, and they're a little more conservative compared to the last crash when they overbuilt. But there is a labor shortage right now, but we did see an uptick last year of single-family construction, but the nice price increase in lumber did not help. So let's look at some areas that I'm looking at, and I'm going to Idaho, for example, next week. Home prices in Idaho could be 30 to 35% inflated. Nevada, 25 to 28% could be inflated. And Texas is about 15 to 19% has become frothier over the last year. So you can't just look at this holistically. You got to break down the demographics and look at migration patterns and what's going on. I don't believe in paying over asking for a home. I found this home when I was looking for another one. I don't fall in love with anything. I'll sell my primary residence tomorrow for the right price. But, I'm urging caution in some buyers. There's a lot of things that depends on paying over asking and the upgrades in the home and the area and looking at the appreciation rates, what have you. But that's alarm bells for my clients, and I take a conservative approach and sit down with your clients and make sure that you're looking at all the angles if that's the right decision. But you are seeing that in the million or less segment, and 1.5 or 2 million or more, you're seeing some price cuts, absolutely, and stuff sitting longer on the market. So you got to really dig into the weeds and figure out what exactly is going on. So single family homes, condos, townhouses, and co-ops are more than 17% above their long-term fundamental house price growth, but far from below the overpricing 65% during the 2006 overvaluation just before the Great Recession. So when we talk about fundamentals, some of the fundamentals are flawed in California. I also do commercial real estate. And, I'm concerned about some of the fundamentals, the way small businesses are treated in the state of California and some other things. So I do think there's some fundamental problems in the state of California that hopefully will be corrected. But I have some concerns there. But I am an optimist and I'm hopeful. Freddie Mac estimated that the U.S. is 4 million homes short of being able to meet the demand of home buyers. So that goes to the construction. We have ultra low inventory levels right now, ultra low interest rates, and the economy, on the surface is somewhat stable. And when you dig into it, there's some concerns. So that's why we're seeing these price wars right now. So let's get into forbearance. In June, more than 4 million Americans were in forbearance. Mid-April, they're saying 2.3 million now. American Skipping Payments Mortgage Bankers Association. I'm looking at other data. I always thought that number from data I looked at and people I talked to was higher than 4 million, but we'll stick with the 2.3 as of mid-April right now, what's going on. So right now there's 2 new proposals on the market. Like I said earlier in the presentation, they keep kicking the can down the road. So now most foreclosures would be banned until 2022 under the new CFRS proposal, Consumer Financial Protection Bureau. CFB would proposes mortgage services changes to prevent a wave of COVID-19 foreclosures. So regulators are kicking it down the road. And I think an example of this, when you look at wages in 2020 to 2021, they're about 3.2%. And home prices went up 16% in the last year, the medium home price. So when you look at this, you want to see wage growth and home price growth at the same rate. So the bottom line is you're going to get to a point where buyers can no longer afford homes. So you're seeing that discrepancy with wages and the home prices in the last year shooting up almost, medium home price almost 16%. So you need to look at that, and that's concerning. Like I said, you got super low inventory, you got super low interest rates, and you got forbearance and rental moratoriums kicking the can down the road, so home prices are still going up. So you need to think, what happens if all those homes actually foreclosed? What would happen? Would there be a market crash? Absolutely 100%. You'll see that right home. So if the current inventory of people on forbearance, which is 2.3 million people, were foreclosed on today, we would see an economic collapse of biblical proportions. And let's just look at the past to see the present. So in 2008, there were a little over 3 million people got foreclosure notices. So in 2008, over 3 million people got foreclosure notices, and roughly 862,000 were foreclosed on. So 862,000 people in the last crisis were foreclosed on. And what happened? Caused the entire economic system to collapse. Right? So 2008, 3 million people got foreclosure notices. 2021, 2.3 million people are on some type of forbearance. Let's just say they foreclosed on all those. There would be an economic crash of biblical proportions. Now, I know some financial advisors and some people are taking the forbearance that don't need it. That could be going on out of those 2.3 million people, and they're saying, well, just won't pay my mortgage and I'll take that extra cash and put it into investments. I'm sure some of those people are going on vacations or even buying a car. I heard that story of someone using PP loans, I know for a fact, and buying cars. So that's probably going on. Financial advisors are telling people not to make their payments, and they're hopefully reinvesting in the stock market and paying off debt. But let's be clear. If you're in a forbearance, you're going to have to do a loan modification. The bank isn't just going to magically say you don't have to pay this money back. It's going to be refactored into your loan. You could get a partial payment reduction or a full payment reduction. I know people that have gotten both, but you're going to have to restructure that loan. Just like in the 2008 crisis, banks double dip. Remember people that needed help on those foreclosed homes? I can speak from personal experience and one individual in particular. The banks double dip. It behooved them to take your home because they made more money. So that's what happened in 2008. That's why I'm concerned about now. On the surface, I see some good things the government is doing, but when big government gets involved in this and they can make money, they'll take your home. And that concerns me. So really read the fine print of your bank and what the provisions are. They are more holistic across the banks and what they're doing to help people. But if you think they're going to forgive a year of payments, and then let's say, they factor that back in. That's the thing. You're not paying down your debt. Yes, your equity has gone up compared to equity increases back in the last crisis. A lot of people now are holding more equity, which is a good thing. But you're house poor. I believe you want to pay down that debt. The goal is to be free of the bank. You're still renting, having a mortgage. You want to pay that mortgage off. So kicking the can down the road and not making mortgage payments, if you need the help right now, yes, do it short term, but try to get back on making those payments to pay down your home. That's the key, is to have your home and it's free and clear. It's a wonderful feeling to have it free and clear and the bank doesn't own anything. But on that track, they're offering some programs of first-time homebuyer credit up to $15,000. Long-term, more buyers enter the market. Prices go, up, inflation. So they're offering a $15,000 credit for people to come in and buy homes, but that could have some negative consequences, as you know. So what are we seeing now? We're seeing inflation, rising national debt, rising cost of living. Bottom line, there's poor fundamentals right now. It's really not being talked about. The national debt is almost $30 trillion. We got inflation going on, cost of groceries is going up, and the rising cost of living over the last 3 or 4 months is going up. So that is concerning. The bottom line is, if the economy continues to grow, on the surface it is, but there are some things behind the scenes that I have concerns about, and low interest rates and low inventory, and that's what's driving the home prices right now. Houses will continue to boom, but we all know if interest rates go up, inventory goes up, then house prices are going to come down. So here's a concerning statistic. The forbearance rate is 2 times what it was in the last crisis. The forbearance rate is 2 times what it was in the last crisis. So when you dig into the details, that's very worrisome that more people are not paying their mortgages right now than in the last crisis. So like I said, if 2.3 million people were foreclosed on tomorrow, the economy would crash. The rental moratorium has been extended as well. But there's a lot of things going on behind the scenes with that too. You have landlords that are not being paid, they're hurting. They're already consolidating going on with major investor groups of their multifamily properties because tenants are not paying, people are defaulting, so people are unloading assets and selling. We're seeing that. I follow that very closely. We're working on a deal right now, trying. So that's concerning. So remember, the forbearance rate is 2 times what it was in the last crisis. Atlanta, Houston, Chicago, and Dallas, highest risk of FHA delinquencies right now. But when we talk about equity, yes, people have more equity in their homes in the markets that I cover. They're very cash rich. Some people have no mortgages. A lot of the people that I know and I follow and researching on. So that's a good sign. But a lot of people did pull cash out. And it's just depends what you do with that money and where this is going. So the fundamentals right now have me concerned what's going on in the marketplace from that perspective. But this forbearance thing, what are the regulators going to do long term? They're kicking the can down right now, down the road, and they're trying to come up with these programs of $15,000 buyer credits and other options and 40-year mortgages, extending your mortgage out to 40 years. I great to get a low payment, but then you're indebted to the bank for 40 years. I just don't believe in that. I believe in trying to pay off. I make double payments sometimes on properties, but if you're going through a hardship, yes, look into things like that. But they're indebting the American people to the banks forever. And that's what's going on in this crisis. With the SBA loans, people getting in debt to their small business. And God, I know you need to keep your business going, so you need help some of these people. You're indebting yourself to the bank by mortgaging your property out to maybe 40 years now. And so think about those things. It's great to have a low payment, but you're increasing your debt load. So that's kind of what's going on right now. And the main thing is the regulators extending this, and we'll see what they do. Take care.